Hello and welcome. If you're shuffling in, and thanks for joining us on our new test of a platform. We're trying to upgrade. We're trying out Demio here. So if you would give us your feedback after the webinar, especially if you attended one of our previous ones with Webinar Jam. We're hoping that this is going to be an upgrade. Hopefully a little bit more high resolution on the slides and people being able to read and more fun on the playbacks if you're watching us on demand. So we'll give everybody another minute or so to get in, and then we'll start right about on time. So I hope you are having a happy Wednesday, or if you're watching it on demand, whatever day it is, hope you're having a good one. So today we'll be talking about probably something that if you're joining and you're watching, you're super interested in, either because you want to think about the future or what's happened with some of the investments that have done super well recently, as the title of this webinar is titled. So again, for those of you that have just come in, thanks for joining us. Happy Wednesday. We are trying out this new webinar software, Demio. So especially if you joined us before on Webinar Jam, after it's over, send me some feedback if you would. That would be most appreciated. Okay. So I'm pretty close to getting started now. Let me share my screen with you here. I'm going to do that one. All right. So hopefully you can see. And we'll dive right in once I get all my windows right. All right. So title of this one, you missed out on AI. NVIDIA is obviously the biggest name there. What's next? So we're going to go through, take a little journey together. And of course, you know, tonight's not about shame or feeling sad. It's about learning about the markets, about ourselves, about thinking forward, looking a little bit back to the past. And let's head down that journey now. Of course, I always need to put in my disclosures here. So I build these presentations I make them the week of that we're doing them, and they take a lot of work. They're very unique. There's nothing cookie cutter here. No one is giving these presentations, but there's only so much one person can do. Obviously, it makes me like 2 or 3 with the AI stuff now. But again, there could be some inaccuracies, even though we try to make sure that everything is right. Be sure you verify things. Check with your advisors or attorney or CPA before making any big moves. And of course, all investments generally include risk, which is a lot of times why you get paid, right? You're taking the risk. So what are we doing today? What are we gonna talk about? So we're gonna talk about what's hot now. Of course, like the title says, AI, NVIDIA. Maybe it's not in the title, but of course, crypto and gold. Some of the other big tech is really taking off. You know, what's the psychology of missing out? Why are a lot of people here? Why are you watching this if it's on demand? Probably it's some kind of FOMO or fear, or you want to get in on the next thing, which could be greed. And it's not a personal, you know, coming at you and judging you. It's who we all are. We're humans, right? And that's why you get manias and bubbles and crashes and panics, et cetera. And we're going to talk about some of those lessons from history, and then hit into, you know, what's possibly next. There's a lot of possibilities, and I'm going to give you some ideas about that. And then lastly, just kind of closing on shifting your mindset and putting everything together that we learned today to hopefully make you more successful in your investing journey through your timeline. So feel free to throw questions in the chat. Sometimes I'll hit them as we go, if I think of it jives, or I'll hold them to the end if they'll fit in better, and I'm going to hit what your question was anyways in the presentation. Okay, so up first, AI and the tech explosion. I hope you like a lot of my pictures. I work and love to play with the AI and even sometimes my own staff and building some things. They're not always, you can see, it's not always perfect, but they're cool and pretty. And this is only even half the picture there. But anyways, when we look at this, you see like NVIDIA rising from 100 billion to 2 trillion. That's crazy. And a lot of people say, well, of course, look at everything that's going on with AI and what's so. And, you know, if you're younger or you were never, you know, really like kind of like a science nerd like me, and I have been down for AI for at least three decades. and then even growing up and reading my sci-fi novels and um, you know, thinking about physics and stuff as you go through school and learn things, and even reading or watching the Cosmos with Carl Sagan and a lot of the things that have just come and everything we've learned. Like, man, I was all about AI, but they've been trying seriously for over 60 years. And there were times where it just kept coming, oh, AI is coming, AI is coming, the singularity, et cetera, all these things. And so it got kind of like, the boy that cried wolf to a certain extent. So again, hindsight a lot of time is 2020. A lot of people say, of course, but man, we have been waiting for AI for so long. And finally, it was its turn to be the market euphoria in there. And of course, ChatGPT let that genie out of the bottle. I remember when that happened, in 2022. I think it was actually pre this. I was reading some articles on it earlier, and I went down to my tech guy. I was like, man, this seems like really awesome. We got to get in NVIDIA and try it. And I got in, and I was like, wow, this is awesome. And of course, it's nothing as good as it is now. But it's been almost 2 years, well, 3 years now since that happened, even though it doesn't seem that long. And you could just see the surge. And Magnificent Seven, you've probably heard that term, Apple and Microsoft and Alphabet, or what used to be Google, Amazon, NVIDIA, Meta, and Tesla have driven, most of the return of the NASDAQ and the S&P almost the last 10 years now. And so, it is worthwhile to ask, is this the real progress or is it a bubble? Because there are a lot of people out there saying that it's a race to zero, right? Eventually, a lot of the AI is going to be for free, and it's what you do with it. Now, of course, the hardware that's generated, NVIDIA is getting paid for it. They don't care, if OpenAI or Gemini or whatever make a bunch of money out of AI. So, of course, that's for real. And a lot of the other Mag 7 could lose money if they're not able to successfully monetize the AI, which no one's really doing that well yet. So in that respect, one way of that happening would be that they start charging you a lot more rather than it being free. But then at that point, how many of people are going to pay? So it's worth, thinking about that it could be a bubble. If people are not making money off of this, that's really the stocks going up. That's what it's about, right? It's about making money and probably why you're here. Looking at some of the other standouts beyond, just kind of the AI side of things. Of course, crypto. I like to call it digital assets. I've done multiple webinars on that. So if you want to watch some of the past ones, feel free to. The last one we did, I think it was the last one, was actually really good if you're interested in investing in it and learning how to do that practically. And of course, gold is just blasting through its former highs and and a lot of people have done very well with that. And that one, crypto and AI was more concentrated on the younger generation, at least the younger generation that had money, right? But gold, there are a lot of baby boomers and silent generation and that really like gold. And so that was kind of their opportunity to ride one of the highs. Energy's kind of bounced back from its lows. Defense and automation, of course, with all the wars and military defense spending, a lot of those things have popped up. And of course, having to invest in new things like drones and anti-drone technologies, et cetera, have been able to do pretty well there. So looking at this, so again, when it's talking about big tech, it's like kind of putting them all together versus, just putting NVIDIA up here. And of course, crypto, when we're looking at the whole decade, has just kind of trounced everything. Okay. And so I would say if you have someone that's a friend or a family member or someone that has just made so much money, and in crypto, it's probably crypto that they made it on, making a decent sized bet, not for their total wealth, but in absolute terms, and then it paying off if they were able to ride it out. And then that's where you're just like, oh man, I missed that. And now I missed the NVIDIA and the AI stuff. It's like, what am I doing wrong? How do I get in on this? And so, again, if there are crypto winners and which absolutely can go down. We've seen crypto go down 70 to 95% when it corrects before the next upturn. So sometimes missing the party, you miss the hangover as well, because a lot of times people they're jumping in at the highs when they got that fear of missing out right before everything kind of comes crashing down. And of course, when it comes crashing down, people didn't think right before, or at least the majority of people didn't think that, and a lot of the pundits would. So, there's millions of people at least investing in these things. I would argue with crypto in at least small amounts, billions of people now investing in these things. That not everything is rational. Of course, one could argue more is not rational than rational. And then secondly, um, you're always going to have somebody saying the opposite or an unlikely scenario, and sometimes those things happen. And so then people will be like, oh well, so and so called it, and of course they get to be on TV and stuff. They called the housing crisis downturn, or they called crypto collapse a few years ago, right before it happened. Well, there's always somebody crying wolf all the time about the bubbles about to bust in some area, and most of the time they're wrong, and then they just keep doing it, and every once in a while somebody's right. Okay. So when you look back and think about emotions right now, I've been saying some of them. Everyone else got rich off NVIDIA, and I sat on the sidelines. I knew AI was going to be big, but I was just afraid. My neighbor made a ton off crypto. Why didn't I know to do this, or have the courage, or the know-how, or why didn't somebody tell me or send me an IM about this? And so if you really were to try to invest in everything, that are in the headlines or that are in social media, and you average that out, you probably wouldn't do that well. Okay. Because you'd have a lot of losers, you'd invest some in the winners. But when you average it out, the losers would overwhelm the winners, at least in terms of like making a ton of money. Now, if you did enough of indexing, that's what we call it, indexing, then as long as you're not concentrating in something, if you buy into enough things, you probably will average out to about what the market averages are, right? And that's kind of like when you invest in an S&P 500 fund or a Vanguard total stock index or what. So that's kind of what's happening. But it's going to be more muted rate of returns, not the concentrated things that we talked about here, that some people invested in and they got lucky. And really, when you think about that, most people brag about the good things that happen to them. And when they make mistakes and really blow up or lose all their money or whatever the case, they don't tell you about it. They don't tell anybody about it unless they think they're going to make money to write some, self-help book or something like that. So remember, a lot of the stories you hear about, there might have been 10 bad ones from friends or family members or other neighbors where they lost a ton of their money, or they're in a lot more debt now, or whatever the case, and they're not going to tell you about that one, right? So kind of keep that, in mind when you feel the missing out emotion. And so most of us, if you're watching this, you're probably a pretty smart person. You might, have a degree or associates or a bachelor's or maybe an advanced degree. But most people that have money have some kind of degree, and they're pretty smart. And they're the ones making the dumb decisions over and over and over again. So just because you've got a degree or you're smart doesn't mean that you're not going to fall victim to some of these things that we're going to talk about, right? Because as we get into it, and you can look up this stuff, there are like over 100 like behavioral heuristics and different things that we do psychologically that at some point in our evolution helped us to survive a little bit better or pass on our genes that don't necessarily translate into being a good investor or predicting the future for complex long-term things like these. And of course, the one you always hear about, or the two, are fear and greed, right? It's kind of the opposite side of things. And so, we're going to talk a little bit about, mental anchoring. Anchoring can be used multiple different ways, but in some of the earlier, behavioral studies or what, so anchoring would can be viewed as like, say somebody gave you a number, say $20 in a conversation, and then they give you a baseball card and your goal is to try to sell it, for as much as you can or to buy it. You start, even if that $20 didn't even relate to that baseball card, by them putting it in your brain, you kind of mentally anchor to that. If you buy a stock, at $100 a share, you're kind of anchored to that $100 per share in terms of how much you made. Or maybe it goes down to $50 and you say, well, I'm not selling it until at least I get back to 100. You're anchored to that spot. Well, what makes it worth 100? Maybe something changed since when you bought it, right? There's new information and it's not going to make as much money as they thought it was going to. A good story like iRobot was going to be acquired by Amazon and really shot up. And as soon as that deal fell through, whoom, went down. And so, that makes sense, right? If you're going to get acquired for a good chunk of change from Amazon, and then you don't, right? But you might be anchored to that $100 a share when there was a good price at 50, and over the next 5 years, it continues to go down to 25 because they weren't able to break the market share, and China and South Korea take over more, and you could have gotten out for a good price at that point, but you didn't, right? Because you were anchored. Agreed override. So a lot of people, they don't want to invest necessarily for the long term. We want things now. You can see in lots of the studies, even with little kids. I don't know if you ever saw that story where they do leave the kid in a room with a marshmallow and tell him if he can stay in there for like 2 to 5 minutes. Then when we come back, if you didn't eat the marshmallow, we'll give you 2 more. If you ate it, that's fine. You don't get any more. And how many of them will actually just take it up right away, right? Versus who actually can wait. And actually, that's actually more predictive of how successful a person will be in the long term than any of the like intelligence tests or anything like that. Is who can delay gratification to get the better thing, and that can make you very successful in life. And then, of course, we've got our fight or flight. And sometimes you get paralyzed by fear as well too. And so anxiety can make you, not choose. And we see that a lot in stressful situations where you don't have all the information. It might be complicated. It's big costs, or maybe there's too many choices, and you get that paralysis. They call it like analysis paralysis, and you just don't do anything, right? So let's keep moving on. And we'll talk about the FOMO loop. So fear of missing out, FOMO, has become way more popular. I'd have to say in the last like 20 years or so. I would say when I first got into the industry 25 years ago, I didn't hardly hear anybody talking about that very much. It might have been kind of jargony in the investment world or what's so, but now I hear it from everyone, high schoolers and young college students and et cetera. But the feedback loop, it kind of goes around in a circle. It's the fear of missing out. Everybody's getting rich. I got to get into this. So you do something impulsive. You buy some of that Bitcoin with your credit card on Facebook. Then you regret it. You're like, oh God, what did I do? I bought something when went up. It's already gone up like 800%. And then I bought it on a credit card that's charging me 23%. And then you're just like, well, I already did it. I hope I make some money so I can pay this off. And so you're emotional about it. This is not just an intellectual investment that you made, that why you got in, for what price, when you're going to get out, or where it fits in your portfolio for what length of time, etc. And you hold it a lot of times to people's detriment because they ended up doing the FOMO thing when the markets were kind of at highs. And then, of course, at some point, they either get out and say, well, the market's rigged, or this is BS, or, whatever the case, and I'm never going to do that again. But then the next different thing comes along, and some people will repeat it again on a different track. And these things might not even be bad investments. It's just the way that we approach it, with that fear of missing out / greed, and the fear ends up pushing us to making almost the exact opposite decision. And we need to break the cycle, right? And breaking the cycle just starts with an awareness of what's happening and how it happens. So again, we talked about anchoring, so when you look at this, and we think about it and say, hey, I should have bought NVIDIA at $150, and that number just stays in your brain. This is kind of the opposite of the one I was talking about with it being high and then going lower, and the stock's at $800, and you're just like, well, I'm not going to buy until it comes down. When it comes back down again, when something bad happens, then I'll get back in, then it'll go back up and I'll make money. But then it just keeps on going. So again, you've got to be and make an analysis of where things are now. And the past is the past, right? So if it's at $800 a share, you're like, it's a great company. They're going to keep buying more. AI is great. I mean, I think that, it could go to 2,000 or 3,000. I did some research and read what some experts think about this. And, their target for 2.5 years away is $2,500. $800 is not that bad. I wish I got it at 150, but that's not, right? So again, another anchoring trap there. And then, of course, the greed coming in to make you make bad decisions. And so chasing momentum, not doing the due diligence that we just talked about, ignoring what something's really worth based on what's happening in the marketplace or what people pay for. I mean, you can do future things, right? That's how stocks are actually priced. If you actually look, or you've heard of the term price to earnings, right? That just is the price of the stock compared to how many years of earnings you have to get to make that up, right? And so, a lot of stocks are trading at 20 to 30 some. So that's 20 or 30 years worth of profits to make the price of the stock how it is now. So people are already factoring in the future profits of the company. And so for it to go up a good bit above that, the company needs to make more than what people thought, right? And then the price will go higher, right? Because the earnings went higher. And if the earnings go higher, then it'll be less years to make the money that you paid for it. And so this is really the fundamentals behind what should be the fundamentals behind stock prices is you're owning the company's future earnings, right? It's not just we're gambling on GameStop or some stupid crypto like Dogecoin or what so. I like many digital assets, but I do not like meme coins. I think there are far too many currency-like, and when I mean currency-like, it's kind of like cryptos that are just like Venmo or something. It's really just about exchanging money between people, and they don't really do anything. But there are lots of cryptos that do. Again, watch some of my previous webinars if you want to learn some more about that. But hindsight bias makes everything in the past look obvious, right? And it creates false confidence, like you're better than you really are. We all do this. I got to say the same thing to myself because we fall into that trap all the time. Because if you look back now, like buying Amazon a long time ago or Bitcoin, a decade ago, you're just like, of course, it's awesome. I just didn't have money back then, or I just wasn't into that type of thing back then. But had I been, I would have been all over that. And that's doubtful. If we're honest with ourselves, but it is difficult to be with that. And so then there's also illusions of control, right? And so, man, the history does not repeat itself identically. We go through cycles of things that are very similar, or patterns of behavior, a lot of because of these heuristics and stuff. And things are different in terms of like how the history unfolds, the players and the people on stage, as Shakespeare would say, but believing that this time it's different, right? And we're going to look at some of these historical context, that gets people into a lot of trouble investment wise, because they think that they don't have to rely on the old things of, like I said, earnings of company compared to the price, like the 90s internet boom. Like it doesn't matter how much money they make. It matters how many clicks they get, how many visitors they get to the website, how much revenue they have, even if they're losing money, right? And it can go to the moon. And so like it's almost impossible to even have a price to earnings if they're not even making earnings, right? So driving those way up, you're taking huge bets that this company's really going to come through rather than just lose money and now have all this debt on the balance sheet. So again, that's just one example. But it's very easy to fall into the this time it's different. And kind of like conspiracy theories, how they work and people get in and create communities with those, is they just think like, oh, I'm different, I'm an in crowd, we know this, everybody else is dumb because they don't know this. That's kind of the same thing with this time it's different. It's like, oh, people are dumb, they don't even understand blockchain, or they don't even understand the internet, they don't even understand the smartphone. And of course, these are things that actually worked. There were a ton more things that didn't work, that people pumped just as much money into and lost it all, or a good bit of it. And again, we don't know exactly how they got out, but confirmation bias. I mean, this is what's going on in our country hugely with the right and the left fighting so much. People don't want to see opposing views. They don't want to be challenged with what they believe. They want to go find things that support what they already believe. And this can happen to you in money and investing and creating wealth. As well. It probably is and will continue to do unless you actively fight against it. Our brains do not like to acquire information that contradicts what we believe. And if you fall victim to that, then at some point you will make egregious investment or money mistakes. Okay. So it is very good. That's why when they talk about diversity is good, diversity of opinions, diversity of thought, diversity of how people run their business, or the different paradigms that they're being successful about, for you to consider them and challenge what you already know and believe, because contrary to popular thought, there isn't just one way to win or one right answer. Okay. And if you truly believe that, there's probably something bad that's going on in your life. Okay. And you may not know it until it really culminates into later. Okay. And then echo chambers. And so more now than ever, even if we're coming back to the confirmation bias, is like people are being friends and going to work and having social media from people that are just like them and believe just like them. And even when we were talking about the AI a lot of times wants to just agree with you and tell you, oh yeah, that's a great point, Phil. I'm glad you said that. That's right. And then I'll be like, that's not how it is it? I looked at this and it said, and I'll be like, oh no, you're right. Now that I looked that up, here's these 5 things, and that was wrong. I'm like, why would you tell me that? So be careful. I mean, even AI sometimes will lead you down, flattering you more than just telling you what the right thing is, right? Um, and loss aversion and missed opportunity. I mean, there's so many good books and studies. The books are the best because they'll do all these scientific studies and they can be pretty dry for a non-science person. But the books that they tell about how it came, like with David Kahneman and Thinking Fast and Slow and Loss Aversion, and just understanding how our brains work, and it's fascinating. Like I said, as we evolved over time, how some of these things that helped us in some way, shape, or form, or we probably wouldn't have them, now don't necessarily help us, right? And one of them is loss aversion. And that is that it hurts you twice as much when you lose something versus when you gain something. So most humans, if not almost all of us, in some way, shape, or form, feel the pain of losing about twice as much as gaining. Okay. And so, and from that perspective, you could see how we would make not optimal decisions, right? Because we're more calculating not to lose more than we are calculating to win, even if the odds are in your favor, right? So if you could flip a coin and win, 6 out of 10 times, and it's an even bet, that's great. Do it all the time. But most people, when they got that 6th or 7th flip, because you'll have some period that's, loss, they're like, it doesn't work, or I can't lose this much, I'm out, and so the loss hurts them more, even though the statistics would absolutely be on their side. That's just an example, but there's more ways that can go. And then missing out, a lot of times missing out on the good things that are happening feels worse because you visualize what you could have made, so you are visualizing losing. And what we say, the losing already hurt you more than the winning helps you. So that's part of that FOMO thing when we're more kind of categorizing it in some of these things. So really what it comes down to on this part of our kind of learning is your brain is just not built for investing. Okay. And we're going to, like, again, we talked about some of the things that did well. We're going to talk about some of the things to think about in the future. But I want you to understand this because a lot of people that are going to come to this webinar, you're there and you may not be realizing it. But the more that we can realize it and understand how our brains work, there's still beautiful things. We can still do awesome things. You can still succeed awesomely. You just need to know what your handicaps are and handicap for them, right? So fear and greed and regret drive most investor mistakes. It's very easy for us to think that bad things happen to other people and good things happen to us, or to internalize good things and externalize bad things, right? And what that means is, like, when something good happens for you, like you got this great job, or you got the part in this play, whatever it is, you're like, that's because I'm awesome and I'm really good at this, and they saw it, and that's what it is. When you don't get the job, or you get fired, you're like, that's because the economy was bad, so you blame it on something else. It's not, I didn't do anything wrong, right? And that's good. That makes human beings not, kill themselves because they think that they're trash, right? When bad things happen to you. But realize it when you're doing things like this, not to get too big of a head, right? And to do your due diligence and to make a plan and to try to stick with it and to be disciplined, right? And be aware of these things, because success, again, we're talking about in ranges here. Success is like only a part of it. And your behavior in terms of you building long-term wealth is the majority of it. Okay. So the question isn't like, what should you buy? It's like, how are you going to do it yourself, whether that's behaviorally and implementing it and keeping control of yourself to do it well. Okay. And even how much you have to invest is a part of your behavior of what you're doing with your career path and how much you spend, et cetera. Yes, I got a question. The recording will be available for later, so you will be able to rewatch or send it to someone else. So let's look at bubbles, right? So for a lot of people, they haven't experienced a crash, right? At least when they had significant amount of monies in the market, because the last one was 2008, 2009, which was like 17 years ago, right? So people are riding high in terms of, there's been some downturns. There's been some 20, 30% market correction, but you didn't have to hold on long before that came back. And if you doubled down on it, you made some good money out of it. So there's a lot of people right now that have not been like stung. It's coming. Let me tell you, this is how markets work. We don't know exactly how or exactly when, but it's coming. Okay. So when we look at these bubbles, whether they be real estate or technology, socioeconomic, et cetera, you start with some kind of innovation, new paradigm shift. Everybody eventually, after that innovation starts to work in, learns about it, people start to get excited. Of course, there's in groups and out groups, and the more it goes on, the more and more people are learning about, oh my God, this is a great technology, etc. Until you hit euphoria to where people are like, what are you talking about? It's worth like 20 times earnings. This is like worth 40 or 60 because they're going to make 2 or 3 times that, and so then they just, whoop, they'll blow the prices way up. And then, of course, at some point, once it goes that far, it's not based on reality anymore of the economics of the business, or the fundamentals of the business, or the asset class, or whatever the case, then you're going to have a collapse, because at some point someone's going to start selling, and other people are going to sell. And when the prices are so high that other people are like, well, I'm not paying any more than this, I should probably get out too. Who's going to buy at that? So you have to sell lower and lower and lower and lower to get a buyer on the opposite side. And you'll get some support. That's what's happened in some of these downturns that didn't turn into recessions, or what. So when the markets are going down 20 or 30%, you're getting a lot of people that haven't been burned in a long time that have money. There's a lot of people buying, with margin, which means they're multiplying their money by taking loans against it, or they're investing with options, and which lets them highly leverage their money as well too, that at a certain point will support it. Like, it's down 20%. It's always going to go up. Kind of like how people thought about real estate, pre 2008, I'll just buy it. And then when it comes back, I'll just make 20%. Right. But at a certain point with a real collapse, it'll run right through those people. Okay. And then at a certain point, it becomes a feedback cycle. because a lot of the people that were investing on leverage or margin or whatever, they'll get margin calls. So there's not enough, the assets went down so far, it can't support the loan. And a lot of people that were borrowing to do this, they don't have a lot of extra money just sitting in savings or other things. So when you get a margin call, they're saying, hey, you have to collateralize this big loan, or we're just selling everything inside of there before you lose a bunch of money that we lent to you. And if you get margin called on a down, it's kind of one of the worst things that can happen to you, because you sell on the way down. You don't get to ride it back. Okay. And that just drives the momentum even farther. Okay. That's a real collapse. And then at a certain point, credit dries up to where people aren't even trusting or wanting to lend to each other. And if you have a credit crisis, which happens with a lot of these big things, and I'll show you some of them, then that's when the real bad stuff happens. And then eventually, regardless of how little or how big it is, as long as we don't destroy ourselves, or there's a zombie apocalypse or an asteroid comes and destroys us, there'll be a recovery. At a certain point, the panic wears off, and everybody's been so scared that things are selling for a fraction of what they should be. And at that point, if you have the wherewithal and the courage, after so many people have lost tons, then you can really, really do well there. But it's hard, because a lot of people at that point, they're tapped, right? And if you had been sitting on a lot of cash, because it's very hard to time these things, you probably didn't get a lot of the up before. Okay. So from that perspective, it's tough to be there at the bottom of a bubble, unless it's just kind of lucky for you that you got an inheritance, or you ended up cashing out of selling some rental, then the markets went way down and you were just like, whoa, whoa, whoa. And then it was really low and you're like, all right, I'll invest now. That just does not happen very often. But if you can do it and you're lucky enough, then it's great. Okay. But being able to time it, I'll tell you, is a very low probability. So let's look some of these historically here. So this is one of the first manias and bubbles to have popped, and you probably heard of it because people love to bring it up. And this was, like 400 years ago, right? That people were doing this, right? And it wasn't the people, the farmers, or what's that actually grew tulips. It was people that were speculating on them. And it generally comes from when there is a lot of credit involved. And usually it might be a small market of people that are kind of speculating. But then if you get a lot of people in that aren't as informed into there, and they start bidding on them, and there are all kinds of contracts and stuff for things that are never going to be delivered, which we do now. You can buy futures contracts on oil and gas and corn and soybeans, and God forbid if you ever have to take delivery of that stuff, right? That's not what you want to do. But you could think about this like then, but lots of people lost, their entire livelihoods here. I mean, it's kind of parallel to how, NFTs shot up at one point, if you want a more modern. But you look at, like, a single tulip bulb, you can see it down there, sold for 10 times like today's like plumber or electrician's annual income. So you think about that today, say the average in those professions may be like $80,000 a year. It's sold for $800,000 for one tulip. Okay. How crazy is that? Like, people like leveraged or put their house up against a tulip bulb just in the hope that it would go higher. What revenues are there? That's super, super speculative. But again, this is one of the first that we have a good record of in modern history of like a mania and then a bust right there. The Mississippi Company was in the 1720s, and this it was more of a French thing and Scottish, and they tried to monetize it with paper money. This was one of the first things of that. And they're like, wow, this is great. It's so liquid. We can do all this. It's going to put stuff over there. They're going to go make money and all this trading, and then we own it. And of course, it got bid up way beyond what it could do. And there was a lot of lending going in so that people could push up the prices, and people didn't want to miss out. And of course, when the riches didn't materialize to what they thought, and to some extent, it would have been very hard to be able to do it. People tried to convert back to gold, and that system collapsed. And of course, it destroyed all credibility for paper money for a long time, which is a shame. It actually, if used properly, and of course, we as human beings a lot of times have to learn before something can be used properly. I wanted to bring this one up because a lot of people don't know about it, but after the Revolutionary War, a lot of our intelligentsia and people that had signed the Declaration of Independence and our Bill of Rights, etc., got into this huge land boom of like, hey, now that we're free and we're just going to keep expanding westward, and they bought up all this land, and land, like, the price never goes down. That was what they said, and it busted. I mean, and back then, if you messed up like this and levered up, and then you lost money and you owed money and you couldn't pay them back, you went to jail. It's called debtor's prison. So actually, one of the more famous signatories on like the Declaration of Independence and the Bill of Rights, etc., went to debtor's jail. He was one of the wealthiest people in the country, was called the financier of the Revolutionary War, and you don't even hear about him because he failed spectacularly in this and went to debtor's jail. So these things happen, and they'll get some of the most highly respected, intelligent people and suck them in and destroy you. So you got to be very careful. The Roaring Twenties, right? There were a lot of boom and bust stuff in the late 1800s and so. But again, I'm going to skip some of them just because they're out of people's minds and thoughts, and they're not going to add a ton. But looking at the history of this stuff, if you're interested, is fascinating. So in the Roaring Twenties, you could see that, people just thought, after the First World War, there would be no more world wars, that we're, making, we were manufacturing, making automobiles, we were going to industrialize and mass produce everything. And, the sky is the limit, right? And of course, that was destroyed significantly in 1929, which was kind of the prelude to the Great Depression. I mean, people jumped off roofs, and people that were multimillionaires, in today's dollars, be hundreds of millionaires, were penniless the next, week or two, right? And so these financial bubbles, or technology, it was technology for them back then. It's not the same as ours. There's like digital technology, but it was still technology, radios and cars and electricity and telephones and all kinds of stuff, right? And of course, it all popped, and we went through one of the biggest downturns, that we faced as a country. The dot-com bubble, I touched on this a little bit already, but again, sky was the limit on these internet, selling things online. Everybody being connected. There were like so many ideas of how we were going to use the computer and the internet to make tons of money, be way more productive. And of course, a lot of these things happened. And we tried to digitize and, bring coax and eventually fiber optic all over the country. A lot of those went bankrupt, and then they were reacquired through bankruptcy. And that's why at a certain point, all this internet, this huge bandwidth that we ended up getting through the late 90s to early 2000s became very affordable. It's because a bunch of people lost their shirts when the tech bust happened. And of course, that's about when I was coming into the industry, or kind of moving that way, is through there, when I was growing up. And it was an exciting time to live, and it was fun to have that technology. And pre that, we didn't have video games and people talking online. You had to do the AOL thing with the screechy internet connection. I heard just last month they finally just discontinued the last few thousand users that were on the AOL. So, but you can see the NASDAQ went up 400%, and people really felt like they missed out. I mean, like, huge. And so people were hugely jumping in, from 97 to 99. And then, of course, the NASDAQ went down 75%. And if you didn't catch a lot of the early rise in there, then you just got smashed. And some people stayed in the NASDAQ just saying, hey, it'll come back. And it really didn't until it was almost back by 2008, 2009, and then you got hammered again. I mean, I can remember working with clients and stuff back then that were just traumatized. So like how much they lost, how long it took them to get it back. And then as soon as they thought they had gotten it back, they just got hammered again with the housing crisis. And so, again, pushing into the next one, which would be the 2008 housing crisis. And then, thinking back to the 1790s to 1800s, kind of land boom collapse, the housing crash. People said, houses don't go down in value. We can't lose money. So let's create this home money and securitize them and make these new things, and we can trade them and we can lever them up, and then we can buy insurance against them, and it can't go down. And of course, by expanding credit and pushing out to people that maybe necessarily shouldn't have been able to afford it and pushing prices up too high, we absolutely did push the prices too high, and they did go down a lot. Okay, so we did our historical kind of look at the past. Now we look at the future, the great unknown. And like I said, even experts get lucky once in a while, and then they'll call it skill when they call it, but they won't tell you about the other 20 things that they called the previous 20 to 30 years that never happened, right? So predicting is fun, but planning and having a strategy, emphasizing your humility and flexibility to admit when you're wrong and in your plan is what's actually key to doing well. Okay, so what could be next, right? So let's look at some of these things, and nobody knows the future. Okay, and so if you get anyone that's like, the next new thing is going to be this, you should buy this, you be very careful of those characters, because a good proportion of them are either they don't make their money off of that, and it's more about sensationalism and getting you to click, and maybe they get something for it, or it could be even worse, kind of like Wolf of Wall Street stuff, where it's pump and dump, where they're just trying to get you to buy something so they can dump their stuff, etc. We got to be open-minded and just think about the future, what could be, and then identify things that you might like to invest in, and maybe one of them will be the next Tesla or NVIDIA or Apple, etc. Okay, so energy transition. We know we need more energy. There are lots of people in the world that are trying to come up, from being in a more emerging type economy, from China to Africa to India. And that's the majority of the people in the world. And one of the main things that they need is energy. And, if we keep, doing it the way that we've done it in the past, we'll destroy our climate for humans. I'm sure the earth will survive just fine. But we're talking about for us and being able to be profit. So things that help with that. And then that's that bottom one down there too, that climate adaptation. Those we could turn into very profitable things, right? It doesn't have to just be like people are, being tree huggers just to be nice to the earth. It could be like, hey, we need to do this because this is what human beings want, and they're going to demand it one way or the other. How can we make money off of doing that responsibly so that everyone can win, right? The old Stephen Covey thing, a win-win-win type thing. Win for the company, win for the governments, win for the individual people, right? Longevity in biotech. How long have human beings been talking about living forever, or at least not dying, or sitting in a facility, staring at a wall, drooling? Nobody wants to do that, right? And so there's going to be a lot of money that's going to be pumped in to people living longer, and when they live longer, having better quality of life. People are gonna want this, and there's certain technologies like that's been out there the last few years, the CRISPR, kind of gene editing, etc. But there are other paths to that as well. Cybersecurity and defense AI. So you're seeing where people get hacked, right? We just had that where Amazon went down. I think they said it wasn't, an attack or a hack. Okay, but maybe they just messed up. I don't know. But that's happening more often. I think with AI, it's going to make it easier for smaller organizations and less sophisticated people to do sophisticated attacks. So there's going to need to be development in that area. People are going to pay for it because it's expensive when those things happen. And there's even going to be AI to fight the AI, right? Space economy. That sounded stupid maybe like 3 to 4 years ago, but now you're seeing Elon do it. It's like, let's put some satellites up there and have internet for the entire world, with the Starlink, and let's privatize what NASA was doing and help them out for cheaper, and we can make a business out of it. Let's eventually go colonize Mars. Maybe we could mine certain things that are hard to get on Earth from asteroids and stuff if we could do it efficient enough. There can be space tourism. There's all kinds of things that could happen there. Quantum computing. You know, we keep expanding our technology and our storage potential and reducing the cost. I mean, this is something that could potentially exponentially increase our computing power if we do it well, and help us unlock new areas of knowledge, etc. Which who knows exactly what the profit potential of some of those discoveries would be before we know them, right? Water technology. So most of our planet is water, but we're running out of fresh water. That's crazy. We need it. We have to have it. We need crops. We got to feed our animals. We got to have water for ourselves. We got to cool all of the AI chips and what so. That it could be a huge thing for water desalination or some such thing. Robotics and automation. At the beginning of the year, I'm doing one on the economics of humanoid robotics, the economics of humanoid robotics. You should check that one out. And you look at some of these things that are coming along. And robotics have been in the past really kind of relegated to niche areas, or like in manufacturing, doing the same thing over and over, where you got to protect humans from even getting around them because they could accidentally, hurt people, or what so. And now with the advances in AI, you put that AI brain in a robot with the how we've shrunken down things, you're going to be able to see them do amazing things soon. Maybe even that that thing that everybody's been scared of for a long time, of taking people's jobs. I mean, I think you're going to be able to see them, do roofing and do electrical and do plumbing and do landscaping, etc. And so that's going to be a good one. So check that one out specifically. Africa and India, already talked about, developing nation, billions of people, and they're kind of, more than likely, if they can get their act together, the next China. And China's taken off. I mean, people may not like it, and there's a lot of beliefs that are standing in front of reality. But China has, as a directed economy, has done a phenomenal job, much like South Korea did a decade or two before them, and they're much, much larger. And they have phenomenal resources, and they have ingenuitive people. So we got to be on our toes. And at least if you can't control what we do as a country, at least you can invest in it. Right? We already talked about the climate adaptation, digital identity and tokenization. So again, talking about blockchain and crypto, and we could talk about, a lot of what's going wrong with social media is, there's no like community accountability, and what's really a human, what's an AI bot. I mean, there can be good money in this, and it could bring civility and stuff back to the internet. And who knows? I mean, if we create so much value eventually, and we don't just give it all to a few billionaires, money may become less and less valuable, and what you do for people and how you help people could become more and more valuable, etc. So again, these are real important things to think about. And then when we dig into these, that you find one that you're kind of passionate, or maybe two or three, then you can find some dark horses or what so that you want to invest in that have got great ideas. And that's really where some of these companies come from. And so if you want to be successful in investing in the long term, though, you got to not just put all your eggs in one basket. I'm sure you probably heard that or read that somewhere, etc. You need to diversify, okay? Because if you put your eggs in different baskets, then you aren't just a victim to something good or bad happening in that industry or that company, or a bad leader that stole or embezzled money, etc. There were lots of people that had their entire everything they almost have beside their house in WorldCom stock. And when they went under, their 401ks were gone, their stock options were gone, and they had pumped everything into there. Things like that can happen, right? And, keep alternatives modest. I mean, it is very tempting to just want to say, well, crypto is going to keep going up. I heard people say, Bitcoin's going to go to 1 million. I'm just putting everything I can scrap into there. That absolutely could happen. It could also go down a lot on its way up over a 10-year period, and you get pushed out. Or you could have invested in something that was more gradual and had Bitcoin as a part of it. And if you rebalance the up and down, you still got close to there for a lot less risk. Okay. And then you got to focus on after tax or tax free returns. So like using your Roth accounts and your 401ks through work and having a strategy. Because if you do things that are just going to cost you a lot of taxes and you like to move around a lot, then you're going to pay Uncle Sam a good bit more than you need to. And you don't want to just let it ride forever, right? At a certain point, you need to take money off the table, buy some of your other things that are down if they're good investments. And then you got to let compounding work. So it's like Einstein said, Warren Buffett said, compounding power of money is one of the most powerful things in our world. And I think it's on my next slide, or maybe it's on the one after. It's not timing the market. So like right now, we talked about the AI and NVIDIA, and I missed out what's the next thing. It's time in the market. So you can look just a 10% annual return, which is a great rate of return when you work in my business, but it's not as high as not near what NVIDIA and a lot of the cryptos have done the last 10 years. But 10% annual return doubles your money every about 7 years. And over 30 years, 100,000 turns into almost a couple million, right? That's without you saving. If you save, you continue to save, like you're doing the percent out of your paycheck or what, so it's going to be a good amount out of that. And that is a high probability win. Okay. So I know you came here hoping to find, the short-term thing. And that's what this talks about. It's called the play money. And a lot of our clients have this. They have things um, they have like a side account that they play with or what so, but the majority of their main money, so like what they've got in their IRAs or Roth IRAs or 401k, 403b, etc., is invested very well with their eggs in different baskets. And they can still be aggressive. They can still have a little bit of crypto as like one of the eggs of the basket in there, right? But then we buy low and sell high and rebalance, and we grow that exponentially with that compound interest over time. And you could still have your play account where you say, hey, I was an early Tesla buyer. I really believed in them. And that's something that I've invested in. I invested in crypto early. I have to admit, I was lucky on that one. I just got into it because I was a solar person and my energy company wouldn't let me get paid for energy. So I mined to use my excess energy, and that's what made me like learn about blockchain and cryptocurrency, and I got in early on that, and that was great. But I'm not going to chalk that up to like I'm awesome. I saw this before everybody else. It's very difficult if you be honest and look back at what the other things were to invest in back then, and it looked like really kind of a silly thing, and hardly anybody took it seriously, right? To get in super early on some of these things. It is not reasonable. A lot of what's going to be awesome in the next decade to 2 decades probably looks stupid right now. But again, if you have some passion about something and you want to invest, then having that play account and having 4 or 5 of them in there that you do and play with it is great. Our clients that do that, we actually keep track of the rate of return for them so they can see when we actually compound it for them over a 20 or 30-year period. For most of them, it's going to be very unlikely that they actually beat our rate of return for the boring, non-sexy investing way. Every once in a while, people get lucky, and that's great. I don't knock people. I love to get lucky. But it's not an actual strategy in life, right? We can play the lottery, you can go to the casino, but you're very unlikely to get rich that way. It's kind of the same thing with thinking that you're going to call the next NVIDIA or Apple or what's so early in its life. And so, takes a lot of these things to heart. Build a plan to be able to build up your main savings, build a plan to be able to have your play money. And if you get lucky, realize it sometimes and take money off the table and enhance this. It will get you to where you're going maybe 5 to 15 years sooner, which is like awesome. Okay. And then if you lose, you still got the thing back there. Maybe it delayed your retirement by a year or two. You didn't mess it up. Right. So, the long game, compounding wins. Like let it work. And when you time the market, like we talked about right here, you could see here that when you miss out, this is just the 10 best market days of the last 30 years, you lost 54% of the entire rate of return. Now, I've done this for a long time, and this sounds like a stupid thing. Oh, what are the odds that I would only miss the 10 best days? Now, all of them, low, but some of them, I had a lot of people do it. So, like, even when like 2008, 2009, the markets were going down, people at a certain point, so I had to get out. Maybe the markets were only like 50 to 60% down as far as they were going to go. They got out and they saved themselves the rest of the down. But then when it was coming back, everybody just nobody believed that was the bottom, and they kept talking about double dip recession and all this, and so things kept going back up, 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 and it took most people 1 to 2 years to even want to reinvest anything, and they missed all that up, which was a good bit more, a lot more than what they saved on the down. And so these things happen and they add up. And then, of course, as us wanting to feel good about ourselves, we don't remember it correctly. And we don't think we did that bad. We just remember, oh, I remember 2008, I got out when it was only like halfway down. They don't remember how much they missed by missing out on the upside over here, which actually made their rate of return 6% per year instead of 10% per year for a 20-year period. That's huge. Okay. So that is the end of our presentation for today. Again, throw your questions in. If you didn't have time to do it or you think about something afterwards, you can always email me or email